Thank you for joining us for our live webinar on Forex trading for beginners. This is Lucas. I'm a business development executive with Phillip Futures. During the webinar, if you have any questions, do type them into the question box and we'll try to address them during the Q&A session at the end of the webinar. Without further ado, let me invite our speaker, Mr. Jun Kit, our FX strategist at Phillip Futures. Jun Kit, over to you.
Okay, hello. Thank you, Lucas, for the introduction. And hi, everyone. I'm Jun Kit, and thank you so much for joining us at today's webinar. Okay, so before we start our webinar, it's important to go through our disclaimer. So it is important to know that this webinar is purely for educational purpose only and does not take into account your specific investment objectives, your personal financial situation, and also your particular needs. So this is only for educational purpose only. Okay, so in this webinar, it will be broken up into 5 main portions. The first one is introduction to Forex. Secondly, we will cover some of the common terminologies in Forex. And thirdly, we will understand a bit of the mechanics behind Forex trading. And fourthly, we will have an overview on the fundamental and technical analysis. And lastly, you should be able to learn how to place a Forex trade on our platform, Phillip MT5. Okay, so introduction to Forex. What is Forex? Forex is actually foreign exchange, or it is known as the FX market. It is a global marketplace where various national currencies are traded, and it can also be defined as the giving of one currency in exchange for another at an agreed rate by both parties. Okay, Forex is also the largest, most liquid market in the world, with trillions of dollars changing hands every day. So according to a survey done in 2019, the daily traded volume in the FX market is actually 6.6 trillion. Just to put things a little bit into perspective, the New York Stock Exchange, which is the largest stock exchange in the world, is only trading about 22.4 billion a day. So that is 22.4 billion, while the Forex market as a whole has a total traded volume of 6.6 trillion. So it is really but the largest financial market in the world. Okay, so it also operates 24 hours a day, 5 days a week. And Forex is mostly traded on margin, and the most commonly traded currency is the US dollar. So before we go further into Forex trading, right, it is important to know the difference between something that is exchange traded or something that is traded over the counter, right? Exchange and over the counter. So what are some of the products traded on exchange? Right, so we have the stocks and the futures. So what exchange means is simply people go to a central location. In this case, for stocks, people go to SGX, people go to Nasdaq, people go to NYC to trade. So they can only trade when these exchanges are open. So same applies to futures. We have the futures exchange like CBOE, ICE, and also CME. So people can only trade in the exchange during the time when it is open. All right, in contrary, OTC market, which is what Forex is. Forex is traded on the OTC market. It does not have a physical location or a central exchange. And so it is spread across the world, like you can see in this diagram right here. So basically, anyone can trade Forex as long as you have a computer and internet connection. Okay, so in Forex trading, there's no resting time for Forex trading except for the weekend. It is because it is run based on something called this trading session. Right, so for each day, there will be 4 main trading sessions. The first one being the Sydney session, because Sydney is the city, or rather the region that starts any day the earliest. So Sydney will start the trading day first, followed by Tokyo session, London session, and lastly, it is the New York session. So after the New York session, right, when it is over, it will go all the way back to Sydney, and this cycle just goes on from Monday to Friday. Okay, so to put it simply, something that we can visualize better is this trading session table. So normally the first session, which is a Sydney session, starts at 5 a.m. in the morning. So this is illustrated in Singapore time. So Sydney starts at 5 a.m. in the morning, followed by Tokyo, 8 a.m., London, 3 p.m., and New York, 8 p.m. So you see New York, it goes all the way from 8 p.m. to 5 a.m. in the morning. So when that's done, the Sydney session will kick in again. So like this, we are able to run on a 24-hour basis. All right, so as someone who's just starting out to trade, right, when should you trade? Because you know there's so many sessions and it runs 24 hours a day. When should we trade? So the answer is actually from 8 p.m. to 12 a.m. Right? So because this time, right, it is the overlapping between the London and the New York session. Okay, so this period has the highest volatility. 70% of all trades actually happens during this period. And as London also represents the Europe region, and Euro and USD is the most traded currency pair. So it's not hard to understand why lah. This is the most volatile because the most traded pair happens to be trading during the overlap of these two time zones, these two trading sessions, right? So this would be the best time for you to trade. Okay, so why do people actually trade Forex out of so many products out there? Okay, it is because Forex is highly volatile. So that means the higher the volatility, the higher the chance of you making a profit or loss from trading these currencies. Okay, trading Forex, you are also able to leverage by opening large position with just a small amount of capital. So in Singapore here, right, the Forex is traded on a 5% margin as stipulated by the MAS regulations. So with a 5% margin, right, you are able to leverage your capital by 20 times. Therefore, being able to make high profits with just a minimal amount of capital. Thirdly, in Forex, you're able to go both directions in your trade. You are able to trade when market is up or market is down. There is no restriction on that. And lastly, this market is highly liquid. So you can buy and sell anytime. There will be always someone on the other side to take your trade. Okay, so that was the brief introduction of Forex as a whole. So moving on, we will cover some of the Forex terminologies you need to know. Right, to start out, let's look at this currency quote. So you can see on the screen is Euro USD. So this is a conventional way of quoting currency. It is in 6 letters. The first 3 letters is what we call the base currency. The second one is called the quote currency or the profit currency. So what this means, right, is that when you buy this currency, when you long this currency, Euro USD, you're actually buying the base currency and selling the quote currency, right? So you long, you buy the quote currency and you sell, you buy the base currency and you sell the quote currency. So the rationale behind this trade is that you're hoping that the base currency, which in this case is Euro, to appreciate against the quote currency. Right, the opposite applies for when you're trying to short or sell this pair. You're selling the base currency and you're buying the quote currency. So in this case, you are hoping for Euro to depreciate against USD and therefore you are selling it. Okay. So now that we have talked about how to read, basically how to read a currency quote, so it is also important to know what are the most traded currencies out there because there are so many countries in the world, so many different currencies. So which are the most traded currencies? The first, it has got to be the US dollar. US dollar is a king in Forex market, right? Followed by Euro, Japanese yen, British pound, Australian dollars, Swiss francs, Canadian dollar, and lastly, New Zealand dollar. So these are the 8 of the most traded currencies. So it is interesting to know USD alone, it takes up like 80+% of all trades. So out of all the currencies traded, USD is actually 80+%. So it is really a major player in this currency market. Right. So within the currencies, right, there are a few categorization. So there's roughly 3 or some may call it 4. So how do we categorize currency pairs? First, we have the majors. Secondly, we have the minors. Thirdly, we have what they call the exotics. Okay, now let's come back to the majors. Under majors, there's a subcategory. Some people may call this the commodities pair. All right, so these are the currency pairs under this major category. We have the euro dollar, the dollar Japanese yen, pound dollar, dollar Swiss francs, and then down to the commodity pair, AUD USD, which is the Aussie versus the US dollar versus Canadian dollar, and New Zealand dollar versus the US dollar. So if you look at this major pair, right, I'm not sure if you are able to spot if there's any similarity between them and why do they fall under this category. Okay, the answer is because they all have USD. Okay, so that is one criteria for a major pair, but that is only the first half of the formula. The second part, to make up this major pair, it has to be pairing a USD and another major traded currency, like the 8 that we covered just now, or rather the 7 that we covered just now. So you can see everything here, the euro, the Japanese yen, the pound, these are all the most traded ones. So these are all we call the major pairs. And why is there such a subcategory called a commodity pair? It is because, Australia or Canada, New Zealand, these countries are highly reliant on the commodities trade. So any changes in the commodities landscape will likely have a large impact in the price or the rate of these currencies, right? So that is the major and the commodity pairs. So next, going into the minors, also known as the crosses. So these are the cross between the popularly traded pairs, like the 7 that we talked about just now, except for USD. So whichever currency that is in a major, they cross each other without the USD, it is called the minors. Okay. And lastly, the exotic pair. Exotic pair basically consists of currencies from emerging markets or smaller economies, like the Hong Kong, Singapore dollar, the Thai baht, Malaysian ringgit, etc. So these all fall under the categories, right? So once again, there are so many different currencies. As someone who's trying to start to trade, which one should you look at? All right. So the answer is actually the majors, and there are a few good reasons for this. Why you should start out with just major pairs. Firstly, it has high volume. Secondly, it is high. High volume comes high liquidity lah. So and then also the spread tends to be narrower compared to the exotic. So what is spread we'll cover later. So essentially, this means that the cost that when you trade this will be lower lah, compared to other pairs. So due to the volatility and the liquidity, right, there's always someone to buy and sell at any time. Okay, so now let's look at the quote of a currency. So I think some of you last time when we used to go to travel, we go to the money changer, there's this buy and sell. Some of us may be confused, what do they actually mean, or which rate do we look at? Okay, so we are here to talk about it. So it is very normal that currencies are always quoted in the sell and buy, or in other words, the bid and the ask. So the sell on the left side is called the bid price, and the buy on the right side is called the ask price. So what is bid price? Bid price is the price where the broker buys the currency pair from you. And it also means that it is a price where you and I, who are the trader, sell the currency pair. Okay, so when I have a Euro USD, I'm trying to sell Euro USD. I'll be looking at the bid price. Okay. On the other hand, if I'm looking to buy Euro USD, I'll be looking at the ask price, which is the price where us buy the currency pair, and the broker will be selling to us at the buy rate. Okay. One important concept to know when we trade forex is something called the pips. So the pips is simply the fourth decimal figure on the quote lah. Because in recent years, it's becoming so competitive. Spreads are getting thinner. So there has this thing called the pipette or fractional pips, because the spread is getting so low that we have a fifth decimal place, and it is what we call the pipette or fractional pips. Okay, so now we've covered what is a bid, ask, pips, pipette. Let's go. Let's talk about what is spread. So spread, it is a cost of trading forex. So when you buy and sell, the rate is different. So and the difference is the cost that you're paying lah. It is what we call the spread. So how do we calculate the spread? It is simply by taking the ask price or buy, which is on the right, minus the bid price, which is on the left. Okay, so taking this example, we take the buy minus the sell. The difference is 0.6 pips, which is the spread for euro dollar. Okay, so lot sizes. Forex is normally traded at a specific amount called lots, and it is actually the number of currency that you'll be buying or selling lah. So there are three main lot sizes that are fixed. The first one is called the standard lot, which is 100k, 100,000. So if 100,000 is too much for you, you can look to trade a bit smaller. We scale it down a little bit by one decimal place. Mini lot 0.1, which means $10,000. And the smallest lot available is something called a micro lot, which is only at $10,000. So you can start trading forex from a micro contract as low as $10,000. So this is a screenshot of an order ticket on the trading platform. So you can see the volume 0.1, referencing to this right here. 0.1 means 10,000 euro lah. So when you trade, you don't have to be afraid of what number that you key in. Whichever you key in, it will be shown to you on how much is actually being traded. Okay, So moving on. Yeah, so that is basically some of the common terminologies in Forex that we need to understand before we can proceed further. So what actually goes behind it, like what are the mechanics of trading Forex? We will be covering that in the next segment. Okay, so in this mechanics of Forex trading segment, we are here to answer three questions. Firstly, how do we make money on a trade? What is the rationale? What's the calculation like behind making a Forex trade that is profitable? And secondly, how much money do we actually need to start trading Forex? Because I think for a lot of us who are just starting out, Forex sounds like something very intimidating. Oh, I need to have a lot of money. So today we're going to go deeper into that and to see if that is actually true. Okay, so the third portion of this segment is what are the costs of trading Forex? Okay, so firstly, how is money made on Forex? Let's take a very simple example. So let's say you are looking to purchase 10,000 euros. So that means you're longing Euro USD at the rate of 1.18. 10,000 Euro USD at 1.18. The cash flow is as follows. So effectively, you have a cash inflow of 10,000 and cash outflow of 11,800 US dollar. Okay, so you're buying 10,000 euro with 11,800 of US dollar. Okay, so euro in, USD out. Okay, I hope that is clear. All right, so what happens next? 2 weeks later, you decide to sell this position when the rate actually goes up to 1.25. Okay, so 2 weeks later, you will be selling this position. You'll be giving away 10,000 euro in exchange for 12,500 US dollar. Okay, so from here, right, we can see to initiate this position, we gave out 11.8k US dollar, and when we close it, we end up having 12.5k US dollar. Right, so that is how you make a profit, and how basically how the transaction works. Okay, so in this case, you end up with a profit of $700. Okay, how much money do we need to have to start trading Forex? Before we go into that question, it is very important to understand something called the margin. Okay, margin is the amount you have to deposit to take up a trading position. Okay, so this amount is usually a fraction of the underlying asset. Like I mentioned earlier, in Singapore, the margin for Forex trading is 5%. Okay, so the purpose of margin is to help us ensure that both parties fulfill their obligations. Both buyers and sellers, they must put up this margin upfront. Okay, and within margin, there are two types of margin. The first one being the initial margin, which is the amount required as deposit when you start a position. Okay, and the next thing is called the maintenance margin, which is the amount required for you to maintain in that position. All right, so there is a margin. So let's take an example, which is a real one, 5% margin in a Forex trade. So how do we calculate how much money we need to start a position? So taking the lot size of 100,000, so you take the nominal value times the margin. So in this case, you need $5,000 to start trading one standard lot. Okay, so for a mini lot, 10,000 times 5%. So you can start a mini position with just $500. Okay, so for most of us who are just starting out, right, there is something called a micro lot where we can start trading with just $50. Right, so this is one really good news that Forex is actually pretty accessible by retail investors with rather smaller capital to trade. Yeah, so we can always start with trading just micro lot with $50. Okay, so leveraging with margin. Basically, trading with margin creates a leverage effects that allows you to use a small amount of capital to make an investment of greater value. Okay, so like I've been mentioning earlier, $500, you can start trading up to $10,000. So there is a leveraging factor of 20 times of your capital. So therefore, a small price change can result in a large profit or losses. Okay, so I think the upside and the downside, like somehow the pros and cons of margin, it is somehow equal. It maximizes your profit, at the same time, it also amplifies your losses. So we need to be mindful that Forex trading is a double-edged sword. But there are ways that we can manage this risk, which we will cover later in this presentation. Okay. So cost of trading Forex. There are two main costs. Spread, which is what we spoke about earlier, taking the ask price minus the bid price. So that difference is one of the costs that you have to pay to trade Forex. And secondly, it is something called the swap. So this swap is not the swap, the derivative that we may know, like interest rate swap, currency swap. This is not. So basically, this is an interest rate, it's like somehow like a fee that we have to pay when we trade Forex. I'll cover that in detail now. So before we go into swap, right, we need to know the concept called the value date. So any transactions made on spot Forex or Bullion, which is gold and silver, they are valued at T+2. That means if you trade today, the settlement date will be 2 days later. So this is due to different banks across the different region, different parts of the world. They need time to process the transaction lah. So there is why there is a T+2 value date after your trade. Okay, there is an exception for for dollar CAD, which the value date is only T+1 because they're basically in the same time zone. So the T+2 wouldn't really concern them so much lah. Okay, so on the settlement date, the actual currency is delivered to the counterparty. And also in extension of the value date, right? So let's say we start a trade today. Let's say today is Monday lah. So the value date, we open today, we close today. The trade will be valued on Wednesday, which is 2 days later. So what if I carry my trade today until tomorrow? The value date cannot be the same, right? Because it has to be T+2. So the rollover is basically the extension of the value date. It happens when you have an open position which is not closed by 5 a.m. in the morning, right? So why 5 a.m. in the morning? We may be reminded of the trading session that we talked about just now. So after the New York session, which ends at 5 a.m., it is the start of the new trading day. Okay, so if you hold a position up to 5 a.m. in the morning, right, there will be a process called rollover, where the broker would open and close your trade at the same price to extend the value date. Okay, so when in the process of rollover, it occurs the swap lah. So swap is charged when there is a rollover of your position. So to explain plainly, swap is the net interest returns that is accumulated on a position that you held overnight. So let's illustrate a little with an example. So let's say you long Euro USD. So basically you are borrowing USD to buy Euro. Because for us who are starting to trade, we don't have the USD. So we need to borrow the USD to buy the Euro. So by borrowing the USD, you will incur borrowing costs on the US dollar. So when you buy Euro, right, you will receive the interest rates for holding Euro. Okay, so yeah. So the swap is just the difference between the two different interest rates that you have. So when there's a positive swap, then the trader will actually gain from the trade lah. It is positive swap. You'll gain some interest from there. If the swap is negative, the trader will actually incur some cost, whereby the cost of borrowing is higher than the cost, that interest of the currency that you're holding is giving. Okay, so that is swap. So to conclude, so trading Forex, Forex is a zero commission trading product. So you don't pay any commission for trading. The only cost you pay is only the spread and the swap. All right, so now that we have covered the mechanics of trading Forex, just bear in mind, because this is just a short session, 1 hour, we can't possibly cram so much into it. So I'm just giving you some basic overview of each item. Okay, so next up we are going to look into fundamental and technical analysis of Forex trading. So how do the prices move? How do we know if it's going to go up or go down, or how do we analyze the price movements to make a trade? There are two main type of approach, the fundamental and the technical. Fundamental analysis, it allows us to shape trading decisions based on the macroeconomic factors that affects the supply and demand for the currencies. So this is really basically looking at news to judge how different factors will affect currency. So the things that people watch out for example, are the GDP, inflation, employment, interest rates, the COVID-19 situation, and the geopolitical events. So some recent examples are like the Brexit, US and China tension, etc. So as you can see from all this, right, these are factors that affect the well-being of a country's economy. And that is what the fundamental analysis is all about. So how do each of these components affect the price of the currency? We can have a look at this table. So this is just a very simplified version of the very few factors that determines the rate of a currency. Okay, so the first, the GDP. So let's go by column. Fundamentals. So for fundamentals, for gross domestic product, you'll be looking at this report called the GDP, which is the abbreviation of gross domestic product. So how does this affect the currency? So let's say if the result for, let's say, the next quarter GDP growth is higher than the market expectation of the GDP growth, so when the results come out, right, the currency will actually appreciate. So same goes to, so the opposite applies when the GDP for, let's say, a quarterly GDP is lower than what people anticipate it to be. So there will be a decline upon a lower than expected release of the data. So basically, this is all about, the market expectation of the outlook of the economy plus the reality. So they'll match their expectation versus the actual data that's released. All right, so inflation. People will normally benchmark inflation by this report called the Consumer Price Index, which is also a measure of inflation. So when there's a higher than expected inflation, it is generally bullish or good for the currency. When inflation is low for a country, it is bad for a currency. So the same goes for employment and interest rate. Okay. So some of the interesting examples we have here. So this is a screenshot of after the release of the non-farm payroll recently. So as you can see from here, right, after the release of a better than expected employment data for the US, the Euro USD quickly tumbled by a lot. So let's dissect this a little bit further. The upbeat employment data signals improving US economy. So the US economy is going to do well based on the employment data. People are getting employed, the economy is doing well, and therefore the US dollar appreciate, right? Because currencies are all in relative terms. When US dollar appreciate, it appreciates against euro, in this case for this currency pair. So when US dollar appreciates against euro, basically your euro dollar pair will drop in value. Okay. Okay, secondly, an example is the COVID-19 pandemic. When it first hit last year in March, we can see a really steep decline in the euro dollar. So basically, the steep decline in euro dollar means the USD is actually gaining strength as relative to the euro. So this is because one of the qualities of the US dollar, it is called the safe haven currency. Whenever the market is in a risk averse mode or off mode, people are afraid of taking risks. So they will jump back into US dollar to hold US dollar because US dollar is seen as a safe haven asset. It wouldn't depreciate much as compared to other currencies. All right. So these are some examples of how the news would affect. Okay, so let's look at some of the headlines that to see the relationship between the currency and some of the fundamental events. So the first title, the AUD USD flirt with bears. So for those of you who don't know, bull and bear. Bear means it is going down. We believe that the price is going down, and bull, that means it is good for the price, it's going up. So this title is saying that the AUD USD is going down amid the coronavirus. So you see the coronavirus, they're saying this coronavirus war is very bad. That's why the US dollar is appreciating against the AUD. So therefore, the AUD USD quote will therefore depreciate. Secondly, a positive COVID-19 development reinforces bullish sterling outlook. So you see, whenever the COVID-19 situation becomes better in that country, the currency will generally appreciate. Okay. So another example is also retail sales and COVID-19 concern. So another factor that affects, another factor to look at in fundamental analysis is called the retail sales, which is how much people are spending in the retail market. So if people are spending, that means the economy is going to be doing better because people, are spending. Okay. Also another example, just to illustrate lah. So it is quite clear cut. As you read more, you'll be able to pick up like what are the events that happen and what kind of effect that they will have in the currency. So it is really pretty interesting. Okay, so as a trader, how do I go and conduct all these fundamental analysis? Okay, so on this trading platform, right, that we have, there's something called the economic calendar, which is a calendar that lists out all the upcoming economic events as well as the currency that it affects. So in this case, you can see the event right here, like the employment change, a non-farm payroll, and the currency that it affects. So on here, you can see the priority. So the priority, that means the higher the priority, the higher likelihood that it will have a large impact on the price. So people normally pay attention to the one that are high priority lah. So okay, so here you can see the forecast price and the actual price. So this is we are capturing a calendar that has already happened. So the actual value is out here. So later on we'll jump to the actual trading platform where you can see live what are the upcoming events. Okay, so this is one portion where you can conduct your fundamental analysis to think what to trade and how to trade. Okay, forecast versus actual. So like I said earlier, when the actual is doing better than forecast, it tends to be good for the currency. It'll be going up. When the actual actual data is worse than what people expect, so it is generally bad for the currency lah. Okay. So secondly, it is apart from looking at the economic events, right? It's also important to stay on top of the latest news, the latest development live. Okay, so this is one feature on the trading platform where you can also see the news as they get updated real time. So we'll go into we'll demonstrate this when we are running through the platform later. Okay, so that is all for fundamental analysis. All right, so now let's hop on to technical analysis. So technical analysis allow us to shape our trading decision using price charts as main analysis tools. We are able to understand market sentiments based on historical price movement and forecast the future price movements. So technical analysis is what that help us determine our entry or exit points. So it is a very common saying, history will tend to repeat itself. This is highly applicable in technical analysis, basically because one of the key assumptions in technical analysis is we are trading on patterns that happened before in the past, and we believe that it will happen again in the future. So therefore, we can lay our predictions in this way. So in this portion, we will cover a few important understanding of technical analysis: the candlestick, support and resistance, channel, and patterns. Right. So this is a candlestick chart. As opposed to candlestick chart, there are also line charts, different kind of charts, but the most commonly used one is this candlestick chart. So what is a candlestick? They are also known as Japanese candlestick, okay? So this is a bullish candlestick. This is a bearish candlestick. Okay, it does look like a candlestick, and it happened to be developed by someone from Japan. That's why it is called the Japanese candlestick. All right, so let's dissect into the anatomy of this candlestick. So within the candlestick, right, there is this body, which is the main portion, the body. So secondly, we have the upper wick, and thirdly, we have the lower wick. So basically, each candlestick will consist of these three main components, right? So so let's hop on to the bullish candlestick. So what does all this mean? So for a green candle, right, the start or the lower line of the body is actually the open price. Secondly, so let's say this candle, right, it opened at this price at the open. Okay, so during the trading hour, during this period, a candlestick can mean like a 15-minute candle or 1 hour candle. So what a 1 hour candle means is basically this candle summarizes the price movement during that 1 hour. At the start of the hour, the opening price is this, and during the 1 hour, the price actually traded from up to high of, the high here, the top of the wick is the high, and or you can trade down to the low point here. So at the end of the 1 hour, it actually closed above, right? So the close is above the open, therefore it is a bullish candle. Within this 1 hour, the price actually appreciated from open to close. But we know during this 1 hour, the price once went up to this high point and the price once went to this low point, but eventually it closed higher. Okay, so on the opposite, it is the bearish candle. The pair open high during that 1 hour, for example, it went up, it did go up, it also went down, and eventually it closed lower than the open price. So therefore it is a red candle. During that 1 hour, the price dropped. Therefore, we can see this bearish candle. Okay, so this is introduction and mostly all you need to know about each candlestick line. Okay, but you know, candlesticks are not meant to be used on its own. It tells us the price movement during the time period, but it is not good enough for us to form any analysis, right? So it is more powerful to use it in a series, like a few candlesticks together. Then we can probably project the potential price movement. Okay, so there are three main kind of patterns that we can look at. It is the doji, engulfing, and hammer. Okay, so due to the time constraint, so this part I may just go a little bit less in depth. So this is called the long leg doji and the gravestone doji. So it basically means that when you spot this, right, after a downtrend, when you spot these doji candles after a downtrend or an uptrend, oh sorry, in this case it's downtrend. So as you can see from this example, it may mean a reversal will be incoming. Okay. So secondly, it is the engulfing candle. So this candlestick pattern called the bullish engulfing candle occurs when a series of price are moving downwards. And they are moving downwards, then there's this bullish engulfing candle with these two candles. It means that the price tends to reverse after its occurrence. So the opposite, the bearish engulfing candle, it occurs when the price has been moving up. Then there's this bearish engulfing candle where the first candle, it went up, but the second candle totally engulfed the previous candle in a different direction. So in this case of a bearish engulfing candle, we can expect the price to reverse downwards after this occurrence. Okay, a hammer. So hammer basically, you see, you start here, you start at the bottom of the body. During the trading hour, it went down all the way, but the buying power is so strong, right, that it ended up going higher than the opening price. So this is a positive candle. So it means that, when you see candles like this, like the market tried to sell, but the buying power is actually stronger than selling power. And therefore, it may be an indicator of a strong, reversal that isn't coming. Okay, so here are some examples. After a downtrend, you can see this hammer candle right here, and it quickly rebounded off, right? And the opposite is a hanging man formation. So hanging man formation occurs after a series of uptrend, and the price fails to go even higher. So it actually went all the way low, but it still closed lower than the opening price. So this also signals a reversal sign for the pair. Okay, so these are some of the candlestick formations. So there are actually many. It is up for you to learn. As you know, Forex is really a huge topic. People can take a lifetime learning and mastering it. Right, so we are just giving you a kickstart into Forex trading. Right, so talking about trend, there are basically three types of trend. You can either go up, down, or sideways. Okay, so you actually map a trend by identifying higher highs and higher lows. So you draw a line, So to identify a trend line, you have to connect three low points to be validated. So you need to touch at least 3 points to validate a trend line. The same is the euro dollar. For this, the downtrend. All right. So support and resistance, common concept that you will hear in Forex trading. The resistance serves as an imaginary ceiling that price simply cannot go up. So when the price reaches this resistance level, right, the selling interest will come in. More selling forces the price to go down. Okay, so when you hit a certain point, when you're low, it's called support. It serves as an imaginary floor that the price couldn't go below anymore, because when the price tries to go below, right, people will start coming in to buy already. Therefore, with more demand, the price will rise. So that is a concept, of support and resistance. So what happens when a price reaches this key level, support resistance? There are two scenarios. It can either bounce away, like you can see from here. It reaches the top band here, the resistance, bounce back, the support bounce back. So after bouncing back a few times, right, when it reaches here, it just doesn't bounce back anymore. It just breaks through to the next target. So there are two possible scenarios right here. So some of the chart patterns that people normally use to identify some price movements is rising wedge and falling wedge. So these are patterns that people see, and there's a high likelihood that the price will go a certain way after this formation. So basically, a rising wedge is a reversal pattern, right? After the rising wedge, price tend to drop, and after a falling wedge, price tends to increase. Okay, so as you can see from here, one example, after a falling wedge, so you see it adhered to the upper resistance line. So it hit its head, come back down, hit its head, come back down. So here, right, when it finally manages to break through, so you can see the next technical target is all the way up here when the falling wedge was started. Okay, so this is how people set targets. Breakout, it reaches the resistance level. Okay, so head and shoulders, these are some of the other chart patterns. Due to the time, we won't be going into them. Okay, so the difference between fundamental and technical. Fundamental is more of a shorter term play. The fundamental is a longer term play. So using fundamental analysis, you determine the directional view of your trade. So it will answer what currency you're buying and why you're buying. So technical analysis comes in a shorter term. Using TA, you can identify the entry point and answer the question when. When do I enter and when do I exit a trade? Okay, some of the common mistakes in forex trading for those of you who are just starting out. So firstly, not doing your homework. Because forex is a huge topic. To do well, you need to read widely on market news and understand how these things can affect your trades. Okay, secondly, is taking on too much risk. As a basic rule of thumb, you should not risk more than 1% of your trading capital on a single trade. Okay, and also thirdly, not having a trading plan. Okay, so some of the tips for beginners are, like I mentioned earlier, we can always start with major pairs for a few good reasons. One of it is also because so many people are trading it, so many news are out there, and there are many available analysis that we can pick from various places to aid in our analysis. Secondly is you can utilize some risk management tools like the risk calculator in the platform, which I'll demonstrate to you shortly. All right. Thirdly is you can use some trading tools on the platform. Okay. So that is all for the part 1 to 4. So in this last portion, right, I'll be demonstrating to you how to actually go on a trading platform to place a trade. Okay. All right. So what we are seeing here on my screen, right, it is a Phillip MetaTrader 5 trading platform. So a brief introduction, it is a multi-asset trading platform where you can trade Forex and CFDs on various asset classes. But for today's purpose, we will be going a bit deeper into a Forex. Okay, so when we start out here, right, and the first question you ask, where are the contracts that I can trade? All right, so there are several ways to do it. I'll demonstrate one way. You go up here, you show your symbol, right? Show symbol. So within here, like I said just now, there are various categories. We have the Forex, CFDs for various different asset classes. So for today, we'll look at what Forex pairs we have. So these are the Forex pairs that is available on the platform. So we've been talking about euro dollar, which is the most traded currency. Let's take this as an example. I double click, it will appear on my market watch panel. From here, you can display all the contract that is available. You can show all. So from here is really everything, but we want to keep it clean for today's purpose. We hide all and we add back the pair that we want to see, Euro USD. Okay, so from here you can see the bid and ask price. So this is the key information you know. But how do we see the chart? Very easy. Simply drag this and drop. drag this and drop. Okay, we can make it full screen. Okay, upon launching the chart, one question you have to ask yourself is, what time frame will you be trading on? There are various time frame, 1 minute, 5 minute, 30 minute. So for to illustrate, I'll use the daily time frame. Okay, so I've chosen my time frame on Euro USD, and also I can customize it a bit more. I can, just right click, go to option, and I'll change the color to something that we are more familiar with. Okay, so I can change the color right here. All right, so that is the candlestick that we talk about. Pretty nice. So how do we form analysis on when to trade? Okay, so fundamental analysis we spoke about just now. We have the news right here. So at the bottom, you can see there's a news tab. So this is a place where you can access the live news. Whenever there's any latest development, you'll be notified here real time. Okay. Secondly, it is the calendar here. It is the calendar here. So whichever currency, any important you can look is here. So these two main functions will serve as your main fundamental analysis tools. All right, so what about technical analysis? Okay, so let's play around with the chart with what we have learned today. So let's try to see what we can see from this chart. Okay, from here I can see something called the falling wedge. We will draw a lower support line here. All right, you see, doesn't it look like an imaginary floor that the price just couldn't penetrate through? Okay, so this is the support line, and also we can draw a resistance line, which is something like this. Okay, so this one you guys can identify, right? Is what we spoke about just now. It is a falling wedge, and it tends to have a reversal. It tends to be a reversal pattern. That means after the completion of this, price tends to go up. Okay, so that's one way that we can use technical analysis, by identifying support and resistance. Okay, so some of the indicators that we've used, which we didn't have much time to cover, like some of the popular trading tools are like RSI and MACD. Okay, so also how do you use RSI? Basically, anything above 70 means that it is overbought, and anything below 30 it is oversold. And from here I can tell you real quick, there is something called the bullish divergence. It happens when the price is creating lower lows. So you can see price here, lower lows, while the RSI, it is creating higher highs. So from here we can see the price at this time, the RSI was below 30, but when we come to here, the price is much lower. However, the RSI is higher than what was previously printed. So this is an indication of a bullish reversal. That's why we have another reason to believe that the price will go up based on this analysis. Okay, so now that we have this basic idea on the direction we believe is going up, okay, and how do we place a trade? Before that, how much should we trade? Okay, we spoke about just not the risk management tool. We shouldn't risk more than 1% of our capital. So there's this function called the risk calculator. You launch that, and you'll be greeted by this window. Okay, so basically, this is based on the price that you're buying right now, with a specific stop loss. So let's set our stop loss around here. Okay, I'm willing to risk 1% of my balance. So you see, risk percentage of equity. I'm willing to risk 1% of my equity. Therefore, the maximum volume I should be trading is 1.95. But bear in mind, this is kind of large because I'm on the demo account, which gives us some free $1,000 demo money to play around with. So that's why this money is definitely inflated than what we would trade with actual money. Okay, so from here we can see we want to risk up to 1%. Therefore, we'll be trading at a maximum of 1.97 lots. All right, how do we place a trade? You can go up here, new order, click on it, Euro USD. Yeah, just now was 1.9 something, right? So let's 1.9 lah. Okay, so we are trading 1.9 lot. From here, you can set the stop loss and take profit level. Okay, stop loss and take profit level. So let's say I would take my profit around 1.1750 lah. 1.1750, just an arbitrary figure, stop loss, and I'll buy. Okay, so this is after you have placed the trade, so you can look at the trade details down here in the trade tab, right? This is your buy, the symbol that you bought, what price did you buy in, and what stop loss that you can buy in. So some may ask, so after I place the trade, can I modify my trade? The answer is yes, and the solution is very simple. You simply hover over to this chart. You see this dotted line, right? It's actually the stop loss level. If you drag it down, so you're actually, changing your stop loss level to a bit deeper, a bit lower. So you'll confirm the details. Once you modify, yes, you're good to go. So your trade has been modified. So we did set a stop loss level. So basically, stop loss level is a level where the system automatically closes out your position if it reaches that price to prevent further losses. All right, so the opposite of stop loss is something called the take profit, where you simply have to drag from this line up. A take profit level is where when the price hits this level, and it will automatically sell for you to lock in the profit. Okay, so that is basically how you place a trade, set the stop loss, take profit, and also how to modify the trade afterwards. Okay, so I think basically that is it. I've shown you how to load a contract, how to load a chart, some basic tools to perform your fundamental analysis, look at the tools, look at the calendars, and also you can utilize this drawing tools. Sorry. You can utilize these tools to perform a technical analysis. Okay, so I think that is all for the platform demonstration. Yeah. Okay, so I think we are almost running out of time, but to end this and to have time for some Q&A, I'll be ending it with a promotion that we are currently having. So this promotion actually runs from now until the end of September, where you will stand a chance to receive 150 Singapore dollars when you open an account. So when you open an account with a minimum initial deposit of $500, you will receive a $50 reward. Okay, but when you start trading, right, you receive another additional $70, and when you provide feedback, you will receive another $30. So completing these 3 steps will give you $150 Sing dollar. Okay, so to find out more about this and to know where to open an account, you can just scan this QR code on the right. Just scan this, and you will be able to land yourself in the page of this promotion. Okay, I think that is it. Okay, I'll show the screen for a bit longer. But to conclude some closing remarks, I think it was a bit fast, but there are so much information to cover. So if you'd like to find out more about our platform, our offering, how to use the platform, and just to know more about forex trading, you can always write into us, and we can arrange a separate one-to-one coaching session where we'll guide you from the very beginning and answer any questions that you have. Okay, on a on customized session. Okay, so thank you for joining. For those of you who are not ready to open an account yet, you can scan this QR code to just try out a free demo account. Okay, so the demo account, you'll be able to place some trades there. No risk, it's for you to try the platform. And also you can scan the middle QR code for our upcoming webinars. And also you can find out more on our current promotion with the third QR code. Okay, I think with this, I will pass the time back to Lucas if we have any Q&A to answer. Thank you, everyone.
Thank you, Jun Kit, for the very informative session on the Forex. I'm sure that the audience now are much more well-versed. All right, we probably have time for just 1 or 2 questions. Okay, so Mr. Uy is asking, are we able to place OCO orders on the MetaTrader 5 platform?
Oh, yes.
Meaning
Hi,
one
Mr.
cancel the other.
Yes.
Can you attach a stop loss and take profit with the platform?
Yes, hold on, yeah. Yes, the platform actually supports various type of order. So let's say if you looking to place a trade, pending order. So So yeah, you'll be able to, there are various types of pending orders that you can set. So buy limit, sell limit, buy stop, sell stop. So buy stop limit, sell stop limit, there are many kind of orders that is available for you to choose. But so sorry, today we are not able to go in deep into all this because this will require some time to explain how they work and when you use them. But yes, the platform does support various type of orders. Thank you for the question.
Okay, thank you, Jun Kit. One last question from the audience is, are we able to check the history of all the trades on the MetaTrader 5 platform?
Oh yes, let me hop back to the platform. Oh yes, so like I mentioned just now, when you place a trade, right? This is the trade panel, and when you go to the history, yeah, so there's a trade exposure history. So under this history, right, you'll be able to see what are the past trades that you have made. Was it profitable or what? So yeah, you can see all this here. It is all in this platform. It is pretty comprehensive.
Okay, great. Thank you. That is all the time we have for today. Thank you so much for being a wonderful audience for tonight's webinar. A link to the recording of this webinar will be made available in our follow-up email tomorrow. If you have any query on the webinar or would like to get started, simply reply to our email and we will get in touch with you. This is Lucas signing off. Have a good evening ahead. Thank you.